What's your general sense of like the Bitcoin perspective on like never changing and kind of remaining rigid and whatever happens, happens, but the chain stays the chain versus some of these other approaches like around the DAO hack and the hard fork? Like, do you think that it's important that Bitcoin has stayed rigid, or are there times where it would have been beneficial to have actually pursued a similar strategy?
Yeah, I mean, I think that's just the difference between Bitcoin and a lot of the crypto ecosystem, and that's okay. Bitcoin has just this immutable chain of property rights, and it's going to TikTok next block. You can't do anything about it. A block will be mined, in the next 10 minutes or whenever it does, and no one anywhere in the world can do anything to stop that. Whereas, like with Ethereum or Solana, like there's times where the chain stops altogether because they need to fix something, and that's okay. It's just that when you're talking about money, global like decentralized money for the world to use versus a smart contracts chain or platform, there's obviously a lot of differences there, and that's okay. I mean, that's where the debate comes in. But when you try to compare the two or claim something is ultrasound money or that they're even competing at all, even though because of the crypto market liquidity, a lot of times when Bitcoin's up, a lot of altcoins chains are also the ticker symbol is up, or when Bitcoin's down, the whole market's down. I think it's just, the conversation or the debate, I guess, if you want to call it, should just be shifted entirely because they're not really competing for the same market, despite what a lot of people think.
Yeah, I think that's a very fair way to look at it. Let's get into some of the charts that you've got for us today. You've got the USDC and USDT circulating supply. So this is Circle's stablecoin and then Tether. The numbers just keep going up and to the right, man. It's pretty impressive to see how fast this stuff's growing. Why is this important?
Yeah, so the past couple of weeks we talked about equity market correlations. We looked at on-chain stuff. We looked at derivative stuff. So today I thought I'd just throw together some stuff about kind of the stablecoin market and how that's blossoming, just to cover something a little bit different, but an important part of this entire ecosystem. So Circle, Tether, the two leading stablecoin issuers, we see rumblings of CBDC talks, whether that's Congress or the Fed governor saying, hey, we need a central bank digital currency. We're seeing what's happening in Canada with that aggressive overreach by government on people's bank accounts and financial services. So all of this stuff is going to be heavily debated over the coming years. And so do you want to hold something like a stable coin that can be like choke point by some central issuer? I think a lot of people are going to come to realize that their money isn't actually their money. So stable coins, they're actually serving a pretty big purpose in the world, in this ecosystem. And no, it's not immutable, decentralized money like say Bitcoin is. That's censorship resistant, seizure resistant. But what it does do is it allows dollars to kind of flow freely on crypto rails. So this next chart, the circulating supply here is about 120 billion year over year. The growth is like 200%. It was about $40 billion combined a year ago today. And so over the last year, these two stablecoins have done like $2 trillion of transfer volume each, which is like an order of magnitude, a couple orders of magnitude more than their actual market cap. So that they're actually like the circulation rate or how fast these things are changing hands is actually remarkable when you're thinking about this versus say dollars in the banking system. And so for the longest time, the crypto market didn't even have any stable coins. It's just like Bitcoin was your kind of your safe haven. And when these kind of local bubbles pop, you had nowhere to really run. And the on and off ramps are really, really tricky to use. So now people, and you can debate, how safe some stable coins are, or if their reserves are backed or not. And that's an entirely different discussion. But a lot of these stable coins, and I think, increasingly so, will just hold treasuries. And essentially they're just like, US dollars treasuries that can be changed hands in crypto markets in, a couple seconds around the world. And so in terms of innovation, I don't know how it's just, another kind of database entry on a centralized ledger, and that's fine, but it's a lot better than, say the legacy banking system and integration with the crypto markets today.
So when you look at these stablecoin, like we looked at both the circulating supply and the annual transfer volume, is it your thought process that just more and more the financial system is going to move over because these are superior rails to other dollar rails, and people who want that stable value, as long as they can get comfortable with any perceived or real risks of what's backing it, auditing it, etc. Once they get comfortable with that, just the entire financial system will flow over into stables?
Yeah. So, I mean, how I think about it is, and I focus on Bitcoin, with almost all my time because I think it fixes or addresses one of the biggest problems in the world today. There's a 300, $400 trillion problem. And we've talked about that. It's a broken cost of capital, right? So if you have money in the bank account, you deposit with a bank, they actually lend your money out for you fractionally. They fractionally reserve your deposit and lend it out to other debtors, but you don't get any of that yield. You don't get any of that upside, even though they're lending it out on your behalf. So that 0% yield you get in a 7% inflationary environment, you're not doing too well. But with, say, stablecoins or in this kind of emerging crypto Bitcoin ecosystem, what you can do is you actually lend peer to peer. So say on FTX, a centralized exchange, you can lend your dollars to someone else that's using margin, or let's say a DeFi protocol, right? You're putting stablecoins into a liquidity pool, and right there's a debate about what's the custodial risk, what's the platform risk on a lot of these protocols. Are they going to get hacked? Are there exploits? And that's something that people are finding out in real time. Like it's not risk free in the sense that nobody there's not the FDIC going to back you if you get hacked, right? But what you can do is you can lend your stables out, or you can borrow dollars at a really a market rate, right? So sometimes that market rate in this ecosystem is 5%, sometimes it's 20%, but these markets are free and open. And these stable coins allow basically, creditors, debtors, people that want to collateralize their assets and borrow or lend to someone else to do that at a rate that's decided by the market, and not 12 guys sitting in a room saying the Fed's fund rate is going to be 0% again. And so I think that's the exciting thing about what's happening with, kind of dollars on crypto rails.
Yeah, it's wild that there's 12 people who make that decision, but that is the world that we live in today. Hey, you, did you like this video? Great. We make 5 of them a day and post them here on this channel. Make sure you subscribe, like the video, and see you next time.